Hey guys, what's up? Shane here from AwakeFX. I want to welcome you to this trading video. Thanks very much for clicking. Now in this one, I'll be teaching you about the ICT concept, Inner Circle Traders concept of fair value gaps. Now this is something which appears on the chart, which allows you to really fine tune your entries into trades. It can be used for entries. It can also be used for exits. Now, in this video, I'll be focusing more on entries, but I'll be showing you how to exit using Fibonacci and tools that I taught you in the previous 4 lessons. So this is lesson 5 of a series. So make sure to check out the first 4 lessons if you haven't done so already. Now in the lesson, I'm going to look at some slides explaining what a fair value gap is. And then later I'll show you 2 examples on the chart of trades using the fair value gap as a confluence in order to take the trade. So let's have a look at the charts and let's have a look at some slides and get learning about fair value gaps. So what is a fair value gap? The way I've come up with this description is based on Inner Circle Trader and my own understanding kind of combined. So the way I like to describe it is a fair value gap. It is a 3-candle pattern where there has been a move in one direction, that's candle 2, that leaves a gap or an inefficiency visible on the chart between candle 1 and candle 3. Okay, so maybe have a read of this 1 or 2 times. It's a 3-candle pattern. There's been a move in one direction, that's candle 2, and it leaves a gap or inefficiency visible on the chart between candle 1 and candle 3. So let's see straight away what that looks like. Now on the left-hand side here, you can see candle 1, candle 2, candle 3. Now we'll look at the rest of the chart shortly, but let's just focus here on the left-hand side. Candle 1, candle 2, candle 3. A fair value gap exists when the high of candle 1 and the absolute low of candle 3, there's a gap. See the way they don't cross over. So if you remove candle number 2, the high of candle 1, denoted here on the right in the yellow line, and the low of candle 3, there's a gap. And that's called a fair value gap. So if you remove candle number 2, you'll see that the high of candle 1 and the low of candle 3 has a gap, and it's just called a fair value gap. So this is kind of in an up move, what that looks like. And then on the right here, we have a down move. So you've got candle 1 here first. Candle 2 moves down, but candle 3 retraces up, but it doesn't pull back to the low of candle 1. So there is a gap or an inefficiency between candle 1 and candle 3. And I draw it here on the right. So the very low, it's actually the low, not the open, the low of candle 1 and the high of candle 3, that's the fair value gap. Now, these can be great locations for entry points into trades or targets. Often they're used as entry points in what Inner Circle Trader teaches. So for example, on the left-hand side here, I might see a move up and then I would expect at a later point price to come back down and maybe fill this fair value gap or a candle to pass down below the low of candle 3 here into this area before moving higher again. And similarly on the right-hand side here, when price moves down and we leave a fair value gap here, many times price will come back up and just tap into that zone there. And some traders will take short positions expecting a move lower. So I would call this a signature. It's a fantastic signature to look for on your chart in the right area. So if you were looking at my previous lessons, 1, 2, 3, 4, I spoke about market structure shifts. I also spoke about displacement. And I like to see fair value gaps appear close to where I'm considering taking an entry into a trade. And I'll show some chart examples here of what I mean by that. So here we're looking at a euro-dollar chart. So we're looking at a currency chart. It's a 15-minute chart. And I'm just going to show exactly what I mean by a fair value gap and how you could potentially use it as part of a trading strategy. So price has been kind of consolidating sideways here. We had a break lower that took out this previous low over here. So let me just mark that previous low up over here on the left. And we'll call that, as I mentioned in previous lessons, the sell side. So price has bounced off this, moved away. So that's the lowest point here on the left. Price has come down, broke below. And as I mentioned before, I look for price to come up into the range and a market structure shift to occur. So let's see what happened here. You can see price moved down from high to low, to high, to low, to high, to low, down into this area. And we're in chart replay mode here, so I'll play candle by candle what happens next. So move forward one candle. So price has taken out the sell stops down here below the sell side. It's moved up. As I mentioned in the previous lesson, I look for market structure shift. And here we have a market structure shift. So let's look at that. Why is this a market structure shift? We had a high here, we moved down, we had our lower high, and it's been taken out by this candle. Now, where is the fair value gap? Can you see in candle 1, candle 2, candle 3 here? These 3 green candles, can you see the fair value gap in there? Is it clear? Let's mark it up. I'm going to use a box to mark this up. Here's candle 1, the high of candle 1, and there's a gap up to the low, this candle here, candle 3, see? High, low, there's a gap. So as I mentioned, if we've got a market structure shift, there's the point at which we have a market structure shift. It's a very strong market structure shift because we've also broken this high over here too. So because this fair value gap happened here, I trust this move higher could continue moving higher. So I may use this fair value gap as one tick box in my confirmation for taking this long. Number 2, based on my last lesson, I'm going to do a Fibonacci retracement from the low to this high. And you can see the 50% level is this orange line here. So we have Fibonacci level. We also have the fair value gap. So we have 2 reasons to take this trade. So let's move forward and see what happens. Price comes down, bounces on our Fibonacci level and also into our fair value gap zone. And as you can see, price moves away. So here's your entry. You have your market structure shift, you have your fair value gap. The fair value gap is telling you the price will most likely want to move higher. And that's the type of trade you're looking for. Okay guys, so this is an example of a short trade using the fair value gap. So let me just show you this chart here and explain this setup in more detail. So as I mentioned in my previous lessons, make sure to definitely check out all the previous lessons because the hour requirement to understand this properly. Over here to the left, you can see this swing high point. I'm going to mark a level there and we're going to call it the buy side level. Okay, why? There's buy stop orders above there. And as I mentioned in previous lessons, I look for these buy stop orders to be taken and for price to come back into the range and give me a market structure shift and give me a pullback up into a zone. And in this case, we're going to use the fair value gap as that entry model. And I'm going to show you the Fibonacci as well in this particular setup. So price moves up. And let's play each candle forward now. Price comes down into the range. That's the first signal that, oh, maybe we might be getting an opportunity. But this could also bounce here and go higher. And if it does, I don't do anything. I wait for price to come back into the range and give me a market structure shift. So right now I'm still waiting. Price moves lower. Where would the market structure shift take place? Well, let's have a look here. We have an absolute low down here. We move up to this high here, and then we have a pullback, and then we move up to this high here, and as you can see, price is obviously moving down. Okay, so we would need to break this low over here for there to be a market structure shift. So let's move forward. There, at that point there, we've broken that low, and that's a market structure shift. So we've got another tick box. So tick box number 1, price comes back into the range. Tick box number 2, we have a market structure shift. Next, can we get an entry point up here in an area of value? Let's look and see, do we see anything else here that we've just spoken about? Can you see the fair value gaps between this high and this low? This is candle 1, candle 2, candle 3. From this low until this high, see that candle low to this candle high, that's a fair value gap. I'll make this just red to denote that it's a potential short trade. From that low to that high, that's a fair value gap. Let's move forward a candle. Also note, there's another fair value gap below. See this candle here, 1, 2, 3. There's also a fair value gap between that candle's low and this candle's high. Now this is a question I've seen asked a lot, is if you get a market structure shift, which we can see happened at this point here, the market structure shift, how do you know which fair value gap to use? There's a fair value gap that's up here quite high. There's another fair value gap here that's quite low. Which one do you go short in? The lower one or the higher one? Well, that's where Fibonacci comes in. You take your Fibonacci tool, you pull it from an absolute high down to the absolute low, down here, and I want to be getting into the fair value gap that's at or above the 50% retracement level. So with that, you could technically take a short trade, let's say 1 pip above the 50% level, for example, and put your stop above the high. I'll just move this across here. So I would look at a potential entry point in the higher fair value gap, not in the middle of it, not at the top of it, but I'm looking at the 50% retracement. Price could just tap in, sometimes can tap in only 1 pip or 2 pips and then move lower. Sometimes it will move higher than the fair value gap and turn up around this area. But I found that entering kind of at the low of the fair value gap or slightly above the 50% retracement, you're getting into an area value. And then I always look, as I mentioned, for that 2-hour trade, 2-to-1 reward to risk ratio, which would be down here at our negative 50% Fibonacci extension level that I spoke about in the previous lesson 4 about Fibonacci. So make sure to check out that lesson if you haven't done so already. We'll move forward candle by candle. Price does get a reaction off that fair value gap. But look what happens next. We move up and we spike into the higher fair value gap. So any traders getting in short at the lower fair value gap might have got stopped out, but we're waiting for the better entry. We'll move forward, the price moves down, hits our target. So this is the kind of trade we're looking for. I've shown trades using the 50% retracement level of the Fibonacci after the market structure shift. But what gives this trade extra higher probability of success is the fact that this fair value gap exists here. Sometimes you might see a break in market structure and no fair value gap. I like to see a fair value gap plus Fibonacci as a potential entry, stop above the high. Some people do put stop losses above the candle number 1 of the fair value gap, or sorry, candle number 2 of the fair value gap. Some people might put a stop loss above there. I think it's better to put it beyond the high, absolute high. So there's an example, guys, of using the fair value gap for short trades, for long trades, and in upcoming lessons I'll look at how it can be used also as a target area, and also to use how to use higher time frame analysis and use fair value gaps too. So I hope this lesson was enjoyable. If you are already subscribed to the channel, thanks very much. I really appreciate each and every one of you who subscribed to the channel. If you haven't subscribed yet, please do so if you do want to see trading videos like this. So thanks very much for watching. Happy trading and take care, guys. Bye-bye.